All right, scholars, we're now going to take a look at how to handle rental expenses on a piece of rental property. And we actually have three categories. We have a residence that you're renting. We also have just a plain old simple rental piece of property, no personal residence associated with it. And by the way, we have a picture of, I believe this is Mr. Olinto's other house, because he's got houses on all the states around the world. So this is one of them. The tax implications associated with rental property of a home are dependent on whether it can be ranged from residence, non-residence. Remember, if it's a non-residence, you can sit there and take all the expenses against the income, but the deductibility will be limited. And we're going to talk a little bit about that as we go through that process. So let's take a look at our first one. What we have here is we have rental days, and there were a lot of them. As you can see, the traditional June, July, and August down the shore, people are going to enjoy it. However, they enjoyed it for quite some time. They enjoyed it for about a month themselves. In this case, we're going to have Geraldine. And Geraldine owns a beach house that she rents for 90 days per year during the summer. She uses the home for 30 days per year. During the rest of the year, the house is vacant. And if you recall, it's the over 14 days or 10% in order to treat it as a residential item. And in this case, we do have that situation. So she's allowed to take her expenses, but she has to prorate them, and she can't create a loss. We have a second example here. In this second example, she only used it for 7 days. She didn't have enough time, a lot of work going on. But she still did rent it out all of June, July, and August. So in this case, what if instead she rented the beach house out for 90 days during the year, but because of work, she could only spend a week there? So now you start looking at it and say, well, wait a minute. It's the greater of that over 14 days or 10% of the time that it was there. In this case, 10% would be 9 days. She only used it for 7 days. So therefore, we don't hit that test and that limitation. So we have non-residents. And remember, with a non-residence, you literally take all the income minus all the expenses equals profit, taxable. And if it's a loss, watch out, we have the passive activity losses. And with passive activity losses, you're not allowed to deduct that net loss unless you have other rental properties with income. But let's assume this is the only piece of property you're renting. Then under those circumstances, we're going to take that loss. Remember, you can't go back with it, but you can carry it forward indefinitely or until you sell the property. What do you do with the carry forward? You offset future income from this property. We have a residence with fewer than 15 days rented, and we have the residence with more than 15 days. But remember, don't forget that 10% test as well. So you have that limitation based on prorated, or we also have if you had your principal residence and you rented it out less than 14 days, the income is excludable. Yeah, that's really nice, isn't it? When would that become a big advantage for you to take advantage of? Well, the Masters. It could also be because of other items, such as maybe the Olympics are coming to your hometown. Anything like that, that income less than 14 days, you can exclude it. Ladies and gentlemen, you now know the real estate rules.